This is Professor Campbell with a summary on inventory and some of the things that are needed in the blueprint. They talk about calculating the carrying amount of the inventory. So you will be using a LIFO, FIFO weighted average. Um, you might have some other LIFO type problems in there as well. Then the next calculation is using the lower of cost or market or the lower of cost or net realizable value. So there are two different ways of analyzing that lower of cost or lower of market, and we'll go through that as well. And then again, you also need to know how to prepare a roll forward of the inventory account balances using various sources. So let's go. Let's take a look at what we have. So in our blueprint, we have to calculate the carrying amount. That is something that you have to do in application. So you have to have remembering and understanding of the different procedures. So those will remind you of what those are as well. And then analyze, preparing a roll forward and reconciling differences would be something that is analytical. Now, there's a reconcile and investigate differences between the subledger and the general ledger to determine whether or not an adjustment is necessary. Most modern accounting systems lock in the subsidiary ledger to the general ledger. And there is very few cases where you can have a difference. It'll be loud and clear who made that difference. And usually systems are designed for internal control purposes not to have that. So it's all theoretical and it could happen. You'll never see this happen in real life. This is just something that's happening in theory, being able to reconcile those. Okay, let's move on. We have two different types of inventory. Periodic inventory, which is typically used by small companies, and they only take the inventory at the end of the period. So purchases are made to an account, and then we take away things that are returned and back and forward. And at the end, we calculate what the cost of goods sold is. So we use this formula, beginning inventory plus purchases equals the goods available for sale, and then I subtract my ending inventory and I get my cost of goods sold. I put this vertically. It's much easier to follow when we do this vertically. Okay, periodic inventory. Perpetual inventories are continually updated for each change in inventory. So those are the inventories you see at Amazon. You see them at Walmart. When you go in there to say, well, I want to buy a case of pop, it'll tell you whether or not the inventory is low. So they have a perpetual inventory system. Purchases, sales, returns of inventory, and purchase returns and sales returns all automatically updated. A physical inventory count is still needed on the perpetual to adjust for errors, breakage, spoilage, pilfering, and they're all recorded when you take a physical inventory in the perpetual. And it's usually done at year end or at the end of the quarter. The physical count, the questions regarding the physical account can be quite complicated depending on what your inventory is doing. So typically we have a warehouse count using tags and scanning barcodes and things like that. We have issues about FOB destination. If we purchased inventory and it's still in transit to the warehouse, what if we sold inventory and shipped it FOB shipping point? It's still our inventory until the customer receives it. So we can have a number of different words. So a lot of paying attention here when they're doing the narrative as to what the words are saying, exactly where the inventory is. Consignment inventory in the hands of the consignee. So it's your inventory in somebody else's shelves and they're going to sell it for you. It's not yet sold. It's your inventory. You have to include it in your physical account. And you could also have inventory on your floor in your sales area that is consigned from somebody else. So that inventory is not yours and would not be included in your account. I rarely see that kind of situation. All right, estimated sales returns. If you have a consistent sales return history and a right of return exists, you need to make an estimate from historical rates of return as to what the estimated sales returns are in inventory. So our roll forward will include purchases, net of returns in periodic, plus freight in on purchases, minus purchase returns in the perpetual, minus purchase discounts, gross or net method. So just like we had sales, we can record our accounts receivable gross or net method. The purchase discounts can be recorded gross or net as well. Inventory adjustment for the ending inventory is on the roll forward. And then finally, the last entry is the adjustment for the lower of cost or market or the lower of cost or net realizable value. Okay, for cost flows, calculating the carrying amount of an inventory is the cost flow. We have specific identification, average cost, weighted average cost, FIFO, and LIFO. And LIFO can have various pools or dollar value applications. Inventory write-downs. For the lower of cost or market, if your inventory is LIFO or retail method, you use lower of cost or market. If your inventory is FIFO, average cost, or any other method, you use lower of cost or net realizable value. The problem will give you all of the information, the lower of cost, the market value, the net realizable value, and so you have to focus on, is it a LIFO retail method or is it a FIFO, average cost, or any other method of carrying, calculating the carrying amount of the inventory. That will determine which one of these applications you use for the inventory write-down at the end of the period. And it only writes down, it doesn't write up. Okay, this is Professor Campbell with a quick overview of inventory, and then I'll get into some TBSs and some regular problems and demonstrations for you on the various cost methods and applications. Thank you very much.